Hello, everyone. I'd like to thank you for joining us today. Considering the current environment, we know that there are lots of things right now that are demanding of your attention. So we hope that this talk can provide some helpful insights during this time of change and uncertainty. Lastly, we wish that everyone is safe and healthy. For those of you who have not met me in person, my name is Clayton Bryan, and I'm a venture partner here at 500. I've been a part of 500 since about 16, and today I would like to introduce you to one of our newer additions to the team, Tony Wang, who is general partner at 500. Tony comes to 500 after a long and successful career as an operator. Most recently, Tony was COO at Color, a leading genetics digital health company. Tony has also spent time at Twitter, where he was VP of Europe, Middle East, and Africa. Earlier in his career, Tony was at Google, where he was a managing counsel overseeing activities in Asia Pacific and Latin America. We're looking forward to today's talk on leadership. Before we get started, please feel free to add questions at any time to the Slack channel that's been dedicated for this event. We'll also cover the questions that come in via Zoom as well. And on that note, Tony, would you please kick us off with an opening statement?
Yeah, well, thank you very much, Clayton. Really appreciate the opportunity to chat with folks. Unfortunately, it's under the circumstances where we're not able to do it live, but these are the signs of the times. Really, first off, hope everyone, as Clayton mentioned, is hanging in there, healthy, strong, sheltering in place. It is an enormous privilege to be able to be part of this organization and seeing how 500 has responded and is making quick and having quick reactions to a very fluid environment. So I just wanted to mention I joined about 6 months ago after being an operating executive at some of the high growth companies, and while I've only been here for about 6 months, I've known Christine, our CEO and founding partner, since the days that we worked together at Google. And while I left to join a small text messaging startup at that time called Twitter, she went on and founded 500 with her partners. And so I've been able to see this incredible, global venture capital platform that her and the partnership and the organization has built and invested in the last 10 years. And so I'm really privileged to be part of that now. So, it's a unique time, and would love to I think with this conversation, would love to share some thoughts around this current climate, what we're seeing, but also just to, on Slack and chat, hear from you all on what's on your minds. If there's something that I can be helpful on, I would love to provide more of my thoughts on it. But even if it's something that I may not specifically have direct experience on, would love to start getting a list of the things that you are interested in discussing and hearing from, because we could collect that and build our program for future webinars to come. So really looking forward to our discussion today.
Yeah, so are we. So thank you very much for that, Tony. So the first question I have for you is, these are tough times for us all. Corporations big and small are facing impacts generated from COVID-19. Tony, would you open up to share a little bit about some of the things that we're doing here at 500 to cope with the times?
Yeah, I mean, one of the things I'm really very proud of is just the leadership team, and obviously they're not strangers to adverse situations, having been part of the venture environment for the last 10 years, having gone through the last recession from the financial crisis. The things that we've been doing at 500, we got ahead of what a lot of regions, we were seeing in a lot of regions. So, we started sheltering in place, or at least announcing working from home a couple of weeks before the official announcement. So at the time, we got some reactions that it was a little bit overreacting, but we feel like the Bay Area has been able to at least achieve some level of flattening the curve through private companies and organizations that have got ahead of it. So large companies like Apple and Facebook and Google and Twitter and others, working from home in advance, and 500 was part of that. So that was something that started that set that tone. We've also done a number of things in terms of keeping communication. So on the executive level, we have a COVID command tracker, and we're keeping track of a number of different projects that each of the executive sponsors are responsible for. And it's loosely based upon what Taiwan had put together. So Christine had basically modeled this off of, Taiwan had done an extraordinary job under the circumstances, given their both proximity and social connections to the epicenter. But they really got ahead and had, about 100 plus issues and projects to really have executive leadership over. And so that's what we've done as well. There's a number of projects that executives are now really spearheading. And then separately, task forces that have been put in place, and some of you all have been involved in those as well. So not only has it been a way to really be able to react quickly, but also it was, as a side benefit, a way for the team to just continue to have means and a purpose for just, getting together, getting on calls, getting, be able to share information when we don't have the luxury of being able to do that in person or in the office.
Yeah. And something that is on the minds of, I bet, nearly all of our more recent batch companies, but probably a healthy percentage of some of the older alums as well, is the state of the current fundraising market. Mm-hmm. And, we've done a talk on this on Monday. We did a talk a couple of Fridays ago as well. But, all of the capital markets have been volatile since the end of February, early March. What are your thoughts here?
Yeah, it'd be curious to hear if, is this consistent or maybe not to what you're all hearing. But, I'll just share a few things that just in terms of what my discussions have surfaced, right? So I think everyone knows, in the last 2 years, there's been a record number of VC funds that have been raised in 2018, 2019, and those are still in active deployment periods. So typically a VC fund would be a 10-year fund and a 3-year active deployment period. So with those funds, record number of capital, and so those are still out there. They haven't been closed. And one of the things for, and this is something I didn't appreciate as much being on the operating side, just because the lack of visibility the whole thing was really opaque. When the venture funds take money from LPs or limited partners, basically they're the ones that provide the capital for venture funds to deploy. They go into it with contractual obligations to deploy that within a period of time. And typically it's in 3 years. So there's, the record number of VC funds are within that window where they do still need to deploy capital. Now we saw, in the .com crash where VCs were actually returning capital because they couldn't actually deploy it in that period. This is in the early 2000s. I haven't seen that or heard that yet. And instead I have heard of VCs pausing and just reevaluating and waiting, but the cost of that, there is a cost to it. So I'll give you a sense of how the investor is thinking about this environment. So if you look at what happened after the financial the great recession, after the financial crisis of 2008. those vintages, those funds that were started and raised during that time from '08 to 2010, because these are funds that were actively deploying during a recessionary period, those funds, averaged a net IRR of about 18%, which, by comparison, the previous, uh, uh, 5 years before that, it was about a 7% net IRR. So more than double of what the performance had been up to that date. So for funds that are sitting out, it comes at a cost because, some of these periods are going to be the highest, activity periods where you're able to get great talent, fund great investors and companies and founders during this time. So that's something, investors have to consider. We did you probably already saw, we did an investor survey, and 83% of those respondents said that COVID would impact their investing plans and activities. So it's a fairly broad and general statement. So, and of course, I feel like there's nobody here that has not been impacted. But if you dig in, to what that means, about 42% have stated that they'll have lower allocation to startups. In some cases, like 10% lower, some cases, 20% lower. But more than half have said that they're going to have the same allocation, or they're undecided. So that's an important sign. It's an important signal, because it means that, what I was just mentioning, that trade-off is being actively managed by these fund managers right now, which is like, well, do we sit it out or do we deploy? And just a note around, those that are undecided. So if you're out there raising money now, so you'll want to be able to determine very quickly whether the funds that you're talking to fit one of the categories I just mentioned, whether they're going to pause and just sit it out, or they are actively deploying, or that they're undecided. And particularly with the undecided category, I'd break that down into about 3 different categories. One, I think this is just pure anecdotal, just talking to people, and this was not part of the survey. So this is more, trying to add a little additional color into the high level numbers that we're seeing. So the category of those that are undecided, I think we'll break down to 3 categories. One is, there's just a number of investors that are just waiting and seeing, because it's a fluid environment. Things improve, things get worse. They're just pausing, and they haven't made a determination yet on what their short to medium term action would be. So there's going to be the wait and see crowd. There's going to be those that are undecided because they still want to deploy, but they want to be opportunistic about it. So they're going to apply a higher bar for checks that will pass through the IC. So while they're undecided, they're open to some opportunistic checks. And then the third, I think, is wait and see, or undecided, because I think operationally it's just going to be hard to deploy, and write checks in a process that they may have been used to, because there's no in-person due diligence of teams, there's no in-person investment committees. So I think the last category, the undecided, is like it's just hard to get people together and figure out how we operationally handle this. And so I think as you talk to funds, and if you're out there fundraising, you would want to be able to, on a lead qualification point of view, try to figure out if they're deploying, and even for those that are deploying, whether they're deploying for their own portfolio versus writing new checks, and if they're undecided, why they're undecided. So this will affect how you sort of bucket the funds that you're talking to. I know I said a lot, but I just wanted to add one more thing. Just anecdotally, what I'm hearing around, a lot of folks maybe have, if you're out or you're getting ready to fundraise, what's the impact on a fundraise now? Well, I think there's largely going to be two big impacts. One is obviously around valuations, and the other is around round sizes. So, I think we've seen companies that have, closed rounds at a third of the target that they originally wanted to raise. Now, it's an open question whether if they continued that fundraising window, whether they could have, gotten more or reached their target. But just given the environment, the decisions, were made to just take what was already committed at that point and close the round and continue operating. So, and then on the valuation side, we've seen some haircut, and again, we're still super early in this, so we'll get more data, as we go. But whereas round sizes could be cut in half or by 2/3, valuations tend to get cut by about 18%, 18-20%, and so that's fairly consistent with what we're seeing in the public markets too. Public market. If you take a look at public market high growth SaaS comps, they went from 10 to 15x revenue with next 12 months revenue to about 8x in mid-March. They've recovered somewhat since then, so between 10 to 11x. So if a SaaS company is on the public side is seeing valuations get discounted by 30-40%, that will have an impact on the private markets as well. And the last thing I would just say there is that valuation is just in a point in time. So while it's the fundraising environment is not as conducive to founder valuations as they were, prior to February 19th. It's just a moment in time. So I think the guidance there is really keep to the long-term objectives and goals for fundraise, which is basically to get capital to reach your KPIs. Because if you're able to do that, the short-term valuations will just be that, right? Like ultimately, the terminal value of your company is not determined in the next 3 months, so to speak. So just keeping that in mind. But those are some of the things that I'm seeing out there in market.
Yeah, I strongly agree with that last part about the valuations being that snapshot in time, and working through some of the other things that are going on right now, but keeping your eye on the long term as opposed to what's going on with the short term regarding the valuations. So all right, well, moving on, so let's switch gears and let's talk more about managing through these difficulties. And so Tony, have you had to deal with adverse macroeconomic conditions in the past as an executive, as a manager of a business? Obviously this economic downturn has been caused by something very different than what we've seen in the past, but perhaps there are some similarities that you can pull together and share with the founders that are on the call today.
Yeah, I have to say, in in empathy to everyone that's facing this, certainly it's unique. I went through the .com bust. I saw the high activity, sort of going up to 99, and then the .com bust in 2000. Also went through the financial crisis in 2008. I have to say that this is very different. You always hear like, oh, this is, it's a unique once in a lifetime. And I think it does a disservice to try to compare it to sort of the .com crash as well as the Great Recession, because a lot of the things that we're facing now, we didn't have to face back then. But also, I can only draw sort of lessons, and I'm happy to share some of my experiences there. But maybe another way to do is, talk about the good news and the bad news around what we're, facing currently. So I think the good news is that this specific acute situation that we're in now is not specific to technology. In fact, technology, I think, actually has a enormous role to play in terms of that recovery. Whereas in the dot-com crash, it was it was a body blow to technology directly, and we saw that it took many years for tech and early stage tech specifically to recover. If you were to take fund performance as an indication of that recovery, up to 99, the 5 years leading there, high strong digit net IRRs by funds performing really, really well, which means those companies did really well. But after 2000, between those 3 years after 2000, the IRRs went down to 1%, and it remained in the single digits until 2008. So that was a prolonged tech effect. We didn't see that, and the good news is that we didn't see that effect on tech in 08. And so, there's some good signals here that this is not specific to tech. And the other good news is that this is not necessarily a recession. So there's two things going on. There's the recession, but this is more of an exogenous shock. So this is more closely related to, like, say, 9/11 than it is to the global financial crisis. Because, the other good news is that the economy was not fundamentally broken, February 18th. And, there's certainly things that were overheating. There was a negative, there were negative, $17 trillion of negative European sovereign debt. Certainly things that were not optimal, but it wasn't necessarily broken. This is due to something that we know, which is, a virus. So the other good news is that we actually know what will get us out of this situation. Unlike maybe in 08, where it was sort of a small, slow motion, over and over, like Lehman going down, Bear Stearns going down, like just, it happened over the course of many, many months. We actually know what will get us out, and that's a vaccine. So the bad news is, though, I don't see a vaccine happening in the next, well, I think when we first started talking about this in February, people were saying by the fall. That seems very unrealistic. I think 12 to 18 months is probably more realistic, if not even longer than that. So we know what we need to get out of it, but we still don't have a sense of what the second order effects are in terms of high unemployment, as well as some of the earnings forecasts that are coming out now, as well as how the companies perform against their Q2 forecasts. I think that those will have sort of add-on effects as we get through this quarter. So it's helpful to have that sort of as a broader context in terms of the stuff that we've gone through in the past and what we're going through now. And I would just say that given that there's depending on where you are as a company, there's certain paths that might be helpful more than others. So.
Yeah. Yeah, I think, the more and more I look at some of the pundits out there, it seems more and more folks are saying, the economy looks like it's going to be able to restart within the next couple of months, maybe the next month or two, depending on news around different therapies that we're able to produce to combat COVID-19. So optimism continues to rise. Next, I would like to talk about a situation that some of the founders, even on this call, are facing today. Some might be facing in the next weeks or months. But and that's the topic of managing through layoffs. So Tony, have you, in your experience, have to deal with layoffs and manage through layoffs? What was that like? Any key insights that you can pass on to the founders that might be facing this challenge in the near future?
Yes, you know, in a number of different situations, probably in all those in 2000, 2008, even in 2018. A lot of people have forgot that we had a downturn in 2018, but we recovered really quickly from it. All of those experienced reductions in force, and happy to provide some thoughts around it. But before I jump in there, I do think though that layoffs is one of the mechanisms, but it's probably one of the ones that you're in your back of the mind are thinking like, what else can I do? And this is where, I think I want to pair some of the, the high level macro trends that we're seeing to actual real, like tangible things that founders could hear from or consider. So, there's a ton of things that you could do short of a layoff, and I could talk through some of those. But what your company, and this is why I mentioned, what you do, your path going forward really depends on where you are as a company. So I would largely put companies in this round into three buckets. Those that are, doing well, you have product market fit, you've scaled, and this is basically, a speed bump for you, and you have to manage a large workforce, manage working from home and things like that. So that's one bucket. The second bucket, I think, are companies that have product market fit but need to start scaling and hitting KPIs. And so there, the big questions are going to be like, how much do I spend? How much do I hire? How much, do I invest in marketing? And then probably the third company third bucket of companies, companies that may have not yet achieved product market fit. You're still iterating, you're still trying to explore, and you may have less than 6 months of runway. I'd say that that's a very different set of tasks and goals that you have to achieve there. So I'm just curious, I know that there's a polling mechanism here. Given those three, I would actually, so the poll, I would say with the poll, I don't know if there's a way to modify that. So there's three, according to the three categories I just laid out. So if I say, hey, you're a company that is sort of, growing, you have product market fit, and you've scaled, that would be category one. I don't know, are you able to edit this on the fly?
I can't edit it, but we could have people answer.
Okay, yeah. So why don't we do this for that first question? Forget about Series B plus. Say if you're a growing company, you have product market fit, you're growing, and this is you're managing more of a mature company that's you're definitely hit by it, but it's not yeah. So I think that would be in the first category, pre-seed. Second category is you have product market fit, but you're in that you need to start getting traction and scaling. That's the second category, and then that's seed, and then Series A, just hit Series A if you are, you haven't yet achieved product market fit. You have less than 6 months runway, and it's that's a situation you find yourself in. So I'd love to see just people on the call. And do we know how many people are on this call?
Yeah, we have around 20 people on the call. And can you see the poll?
I can, yeah.
Okay, yeah.
I don't see the results, but
Okay, yeah, poll in progress. We have a few people who have voted, and majority said they were in the seed bucket and that they had less than 9 months of runway.
Okay. Yeah, so number two, less than 9 months, 9 to 12 months, 18 months. Okay, so that's helpful in terms of, so why don't I skip to that? Because like if you're doing well prior to this, this is a golden opportunity to get really incredible talent. you know, there was not that many tech companies hiring in 2000. Google was one of them, and you know, was able to pick up a ton of people. Then the second category, if you have product market fit and it's time to scale, I would say that now is not the time to burn cash to reach milestones. I think, you know, if you are able to do that efficiently and you're able to do that as a way to drive your business, you know, that's one thing. But in the past, a lot of early stage companies have basically, you know, raised money to grow, and that's definitely not the path forward now. I think what you would need to pair that with is really close discussions and communications with your investors, with your board, with your advisors on what your strategy is during this time. And by the way, I don't think anyone, 12 months from now will say, hey, you didn't grow, Q2 to Q3 or Q1 to Q2, you know, what happened, right? So that's something, you know, as long as you're maintaining really clear communications, and we can talk a little bit about that. I think it's not the time to burn money to reach KPIs that otherwise might have been appropriate to reach the KPI to get to your Series A in a different climate. For those that are sort of in that, hey, I have less than 6 months or less than 9 months, you know, still trying to figure out product market fit, what do I do? So, you know, we talked a little bit about layoffs. I want to talk specifically about that. But before even layoffs, there's so many things. You know, I want to get really tactical about this. Like, in terms of cash management is super, super important. So one of the things on, you know, on the operating side, which I've seen, and you know, the founders here probably have experienced too, is that you can talk to different people who are very well respected in their fields and get completely different pieces of advice from them. And so as a founder, it's hard to know, like, hey, well, you know, I respect both of these people. They were advising totally different things. And the dirty secret is like no one knows, and they can only base it upon their own experience. And it's really you as a founder that knows what is appropriate for your company. Occasionally you have you have situations where the advice is exactly the same, and we are in that environment now, and you probably have heard it too. The advice now is exactly the same, which is to preserve cash, preserve runway. And when when people are saying exactly the same thing, that's when, you know, okay, well, something's going on, I got to pay attention. So I want to talk a little bit about that, cash management. So understanding your runway, make sure that there's someone that yourself and the people on your team understand, you know, even, you know, like what's your payroll and the taxes that you have, and how long will that last? Because I think the two things that a startup has is speed, and the second is cash. Those are really the two, you know, pieces that of assets. I mean, of course, you have people, you have IP, you have technology. Speed and cash are your biggest you know, assets in a time like this. So I encourage all of the founders I work with is to have what's called a zero cash date. So once you understand your runway, you know, including taxes, payroll, and everything, you have a zero cash date where, you know, you get to zero, and you want to be modeling out different scenarios, right? So the different assumptions, you know, you have downside scenarios, you have, you know, sort of upside, and figure out what that range, and because those scenarios will move your zero cash date, and figure out what that range is and what you need to do to be able to manage to, you know, the closest zero cash date that you have. And in terms of managing cash, it's always easier to, you know, so you have, you know, at your disposal, you have accounts receivables and you have accounts payables. It's always easier to manage your expenses than it is to, push up the top line or increase margins. A lot of times when you're budgeting and you're saying, hey, if, our budget to the end of the year will take us to, X, Y, or Z, right? You got to be really clear with yourself about how much of that is, can you control, meaning expenses, and how much of that is built upon projected revenue. Because the projected revenue you will have to take a big discount towards, and that's why you want to do different, model out different scenarios. In terms of helping with the expenses, things that you can be doing right away, taking a look at the contracts, your vendors, your supply agreements. What are the payment terms, right? Start making calls and start negotiating net payment terms from net 30 to net 90. Are there contracts that you can extend and say, hey, in exchange for a longer term contract, can you discount that rate by 5% or 10% or something like that? Because you keep in mind that the vendors that you're talking to are also, they're also trying to make bookings. And so if you can say, hey, well, you can book this annual contract instead of my month to month, but in exchange, I really need the payments to come down. Those are conversations that you can have. One of the biggest areas is marketing spend, and that one is entirely within your control. And then, typically the fear and risk there is that if you're reducing marketing spend, then, then from an external optics perspective, it feels like, well, you're not really growing. But that gets back to what I was mentioning earlier, which is in this environment, the traditional KPIs, I think, would defer to a much stronger, priority of being able to get through this period. As I mentioned, we know what, unlike the global financial crisis and the dot-com bust, we know what will get us out of this situation, which is a vaccine, but it's not coming anytime soon. So, it's 12 to 18 months at best. And your goal as a founder is to be around when that happens. Have your company survive and be around to be able to you can have an amazing company, and just make sure that amazing company is around when that vaccine hits, because that's when we can start, getting back to a business as usual and start looking at traction and KPIs and things like that. Other things around cash management is your cash collections. I think that's another one where, in thriving times, it's less of a focus. Like the CEO or as a founder, you're probably not getting to it, but in times, and I've had multiple times of doing this too, just getting in and having, daily, weekly, like where are we in terms of collecting? Because the cash piece is going to be really important. And again, just as you're looking to negotiate payment terms, your vendors and suppliers and your customers are going to be looking to negotiate payment terms too. So it's just, if you're booking revenue and payment terms coming up, find a way to, if you can get cash now in exchange for, say a discount or something, cash now is really, really important. So those are some of the things you could do to manage cash, is, you're both on the AR side as well as the AP side. I would say that in addition to that, though, you definitely do want a plan B as well as a plan C. And then know what will trigger each of those scenarios. And, that's where, for example, Clayton's question around the layoff, could come into place. Is the layoff plan B, or is it plan A, or is it plan B or plan C? There are different ways of doing it. You could do a layoff. You can also do furloughs. Happy to talk more about those. But I know, I wanted to, I've said a lot around cash management, and, Clayton, should I should I continue? I have some thoughts
Well,
on doing layoffs specifically, because I think those points are really important.
well, there's a couple other topics I want to hit on, and maybe we can circle back at the end of the time on layoffs and furloughs.
We also
Um,
have a question in the chat and Slack whenever you want to get to those.
Okay, let me push through for. I have a couple more questions, and then we can circle back on those Q&A questions. So one of the things I think everyone is dealing with right now is keeping team morale high. During this uncertainty, and so what are some of the ways that you've done that, dealing with similar situations? Reflecting back on 08, 09, and 2000. Or in some cases, even having to get the morale back on track, restarted, period. Would love to hear some of the insights that you can share there.
Yeah, I think one of the most important things during this time is honest and fast communications. I think one of the worst things to do to morale, because, superficially, when people hear morale, people think, oh, well, we needed to, pump people up, get people excited, help them see the silver lining, that kind of stuff. I happen to feel that's important, but I happen to feel that is counterproductive in many cases, because in a situation like this, that could feel very disingenuous. So I think the most important thing that I've seen and I've learned around building that team morale is not so much on the surface level of like getting people excited or positive. It's around being transparent, because you build trust by being transparent. I think like one of the best things for morale is to be able to be transparent and straightforward and say, this is what we're facing. This is these are the things that we'll need to do. And part of building morale is having a plan around it. So, obviously being transparent around the challenges the company faces, but also being very quick to be able to put a plan into place. Because I feel like, that will build confidence as well as trust. Having the plan builds confidence, having the transparency builds trust. That when that's developed in a time like this, that goes a long way into, building that company culture. Because when things start turning around, and things, again, they will start turning around. When things start turning around, people will know that, if you're saying, oh yeah, we're close on getting this, $1 million contract in place, they'll know based upon, how the company was run when things were tough, that that's actually a real event, right? That I think where it starts really, where morale gets really hit is when there is a monotone around just, don't worry, we can do this, positive, 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 and then things don't really change, right? I think it's around being honest. It's around building trust through being honest, and and that may mean that you're going to have a lot of difficult conversations. And the one, maybe, there's nothing good about this environment, but the one good thing is that every company is facing it. So, in the past, one of the reasons founders were sort of shied away from it is like, hey, it's really hard to get talent. It's, I don't want to freak people out. They're going to go to my competitor or whatever. In this environment, no one's going anywhere. And so, well, I should say that. I mean, in this environment, it's much less about, a competitive talent in context. But, like, if there's any advantage to be able to bring your team along with you in that, in tackling these challenges, it's sort of the fact that, hey, we're all in the same boat right now.
Yeah. You kind of touched on another question I had here, so we knocked that out around effective communication. I think it's so important right now to be able to communicate, to the rest of the team as well as to your investors, and all the different stakeholders right now as far as the conditions of the business and the plan that you want to adhere to moving forward.
Yeah, just one note on that. We have daily stand-ups, and our executive team meets every other day. So we have daily stand-ups with our teams. It happens, same time every day. Everyone's zoomed in. Our executive team meets every other day, which we didn't do, pre-COVID. So having that, tight coordination, clear communication, and trying to get ahead of, because there's nobody in this environment that will, that will not expect bad news, right? So get ahead of that with your investors, with your board and others, and bring them along with you.
Yep. Last question before we go back to the Q&A. So there are some times where you have to make a bet on that could decide the quarter or maybe even the company's fate for the year. And I know a lot of companies today are thinking about making a pivot to save the business. How do you face a challenge like that? What type of frameworks did you employ to help make those decisions? Any insights you could pass on to the companies now that are thinking about maybe doing something a little bit different, considering the changing ecosystem?
Yeah, so this is really important. I think if you're, it depends on where you are as a company, right? So again, if you're in that first bucket, you have product market fit, what's driving your business, that's one set. But if you're sort of in the trying to figure out product market fit, there's a temptation for some of the early stage companies to go after revenue. And it's easier to make revenue where there's an existing line item for it from buyers. But it also means that if there's an existing line item for it, it's also very competitive. So you can probably get traction there earlier, but because it's so much more competitive, at the end of the day, is that really what's going to make your company? Now, I'm not saying that going into competitive fields is a bad thing. Like Zoom went into one of the most competitive fields and became a winner. So there's always exceptions. So what I meant to just sort of emphasize is that there's a temptation for early stage companies to be drawn towards revenue, and you got to be really, really thoughtful about, is that revenue, is that business model, is that product or service that we need to deliver to get that revenue, is that going to be the long-term winner for us? Is that going to turn our company into that long-term winner? A lot of times, sometimes yes, and a lot of times no. But then you struggle with this, well, should I get revenue or should I not? Well, in this environment, it makes it so much more clear. So you're able to basically say, look, there's some revenue there. It's diminishing, so the draw there is decreasing, but it's not going to be the fundamental game changer, and that will make us an outsized outcome for our business. And so we're going to be heads down in the next 4 to 6 months to really deliver what we believe is going to be the true product that we originally intended, because we got sort of distracted by revenue that was easy to take and it was on the table. In some cases, they will still be on the table. In some cases, they won't be on the table anymore, in which case it makes it easier to really focus on that long-term bet. So that's a really good opportunity now, which was really hard. In one of my previous companies, it was really hard because there was revenue on the table to be taken short-term. And as as founders, one of the biggest costs, as your biggest assets is your time and cash and your team. One of the biggest costs is prioritization. And if you're going after sort of short-term, non-terminal outcome revenue, it does just prolong that period. And I've had some experiences there where we've had to reset. We've internally had to reset, not due to anything else, but we've internally had to reset and then really go after long-term revenue. And the nice thing about this environment, if there's nothing nice about this environment, but one positive is, you could use that as a way to force a reset so that you can, if you felt like you were looking at sort of short-term non-terminal revenue.
All right, well, let's thank you for all those responses. Let's move things over to the Q&A portion. So Elle from the Atlas has a question on Slack. This is a perennial question on mental management when you're doing it all. Any suggestions for maintaining big strategy orientation for team while dealing with really tactical things such as SBA loans, runway, etc.? I find it hard to swing back and forth.
It is very hard. And, anyone who's worked at a large company or even your teams, everyone struggles with it, because if you talk to your VPs and talk to your, managers and directors, everyone will struggle with that, whether they know it or not, because they're optimized on very specific things that they have. And that's why, just as an aside, that's why one-on-ones with your team are so important, because they are optimized for that very tactical, rock that they have to push up that hill. And you as a manager will be looking at a broader picture for them and for that team. And so this is really important during the one-on-ones to have that reset on a very, very regular cadence. Same thing with you as a founder, as a CEO. It's like, well, who do I go to for that? Well, it's your board, your investors, your advisors, have, coaches, mentors, others that you can use, because they're not going to know whether what the affiliation rules for the SBA and whether you qualify, all that stuff. But what they can do is provide that higher level strategic, like ask the right, just talk to them like, hey, help me figure out if I'm asking the right questions, because that's often what needs to be done. So you could use those as a time for, and that group of peers to be able to help you up level and be able to be more strategic and be more impactful while you're, with your teams doing much of the tactical things. So just know that you struggle with that, I struggle with that, everyone struggles with it. And that's why it's important to have these one-on-one relationships to help reset.
And it looks like Leonard pretty much took over the questions on Zoom. So let's jump into those. Tony, you mentioned that Google hired aggressively during the bubble to land the best talent. That would seem counter to the advice we hear about conserving cash, given headcount is greater than 70% of expenses. Can you give context for why Google decided to hire so aggressively then while others may have been cutting headcount expenses?
Yeah, I mean, I want to make sure that this is not taken the wrong way. Absolutely conserve cash, even if you're in that first bucket. And it wasn't so much to suggest go on a hiring spree, but it is, and if you are fortunate to be in that first bucket, it is like, I think your hiring bar has just gone way up. Your candidate pool has gone way up. And the ability to get some superstars is a definite reality. Whereas, February 18th, one of the hardest things you had to do as a founder and a startup was to hire great talent. And so, it's not so much expanding that and blowing out your budget to hire people. It's more, you're in the fortunate position of being able to have your pick. And that's a really important position. Now, part of that question is, why did Google do it? Google did it because they had this enormous cash machine that was generating free cash flow. And it was able to provide under market salaries in exchange for, having sort of, stability. And, they hired a ton of folks at Bell Labs, and, there was, everyone was really, and part of that is like these companies that were built on old economy, and Google was, really pioneering the new economy. So I think if you find yourself fortunate in that position, go out and get the best talent in your field right now. That's a best opportunity. But you want to be careful, because not a lot of, and that's a unique position that Google is in, and hopefully that you're in as well.
Yeah, sorry, there was a second part, more of a statement, but it says, I want to balance cash management versus strengthening our market position while others in our space may be retreating.
Yeah, I love that perspective, and because it's a perspective of strength and opportunity, and I would just say, if you're going to do that, make sure you have make sure you have the cash runway, right, to be able to get ideally 18, 24 months, even with you being aggressive in terms of acquiring customers or and spending to grow. The one thing I would make sure happens is that your board, your advisors, and your investors are and this goes to the importance of really strong communications around this, because this is an opportunity, right? This, if you happen to be in a strong cash position, it is an opportunity to start building that moat. But just make sure that the team around you is aware, and thank you, is that there's no surprises. If for some reason in 6 months you have to shut that off, and then pivot or change courses. So I think it's absolutely a fair question. Just strong communication around your team is even more important if you're going to do that.
All right, last question. Do you see LP capital call defaults or denominator effects being an issue like prior recessions? This has potential downstream fundraising implications as we want to plan for.
Yeah, Leonard, I love your questions. So maybe just some background in terms of the denominator effect for folks on the line that may not be as familiar with it. So basically, so the LPs, the limited partners that are the ones that provide capital for venture capitalists. There's a wide range of them, but just take traditional institutional capital like a pension fund or endowment or foundation. They allocate assets and capital according to, very similar to how you would do it. Like you would, maybe put, like 40% in bonds, 60% equity, depending on your age, all that stuff. So they do it, they're using public equities, they're private equities, alternatives, real estate, debt. They have a very rigid portfolio management and formula that they're following. Now, what they saw was their public equities all of a sudden get smashed by 30%, 40% in the last 2 months, which basically means their asset allocation, the denominator shifted dramatically, so that public equities is now a much smaller portion of their overall capital. And then their allocation to venture, for example, is now much higher than it would have been, even though nothing happened in venture. It was just more the denominator shrinking. So I think it's absolutely something that's happening, and it depends on how often that institution is rebalancing. So a lot of institutions rebalance on a quarterly basis, and then it's a question of like where the public markets are, at the time they rebalance. So I think what will, rather than institutions just defaulting, across the board, I think it really does depend on the type of institution. So, I'll give you an example. If this is, these are high net worth individuals and, family offices, I think that denominator effect will affect that group class much more. So, with your venture funds that you're talking to, find out, hey, who your LPs are, what is their risk of default. If it's more around the foundation, pension, and endowments, they are really long-term investors. So, and their assets, are enormous, and so their exposure to venture could be anywhere between 5% to 15%. So it's not going to be a big part of their portfolio. So that might have gone up, between 10% to 18%. but you know, I think the likelihood of defaulting there is going to be lower. So when you hear about defaults, it's usually going to be in a certain class of LPs. I would say so corporates would be in I would put in that category of potentially pulling back, not necessarily defaulting on capital calls, but pulling back, deploying new capital. So that's something just to be aware of as you're out there talking to venture funds. And you know, I definitely think that there's going to be a class. There will be defaults, but it'll be class dependent depending on the type of LPs that a venture fund is built on.
Well, Tony, thank you very much for passing along all the wisdom and the insights. I think that concludes this session. So, you know, everyone, please give a virtual round of applause. We'll pretend like we hear that. Yeah, thank you very much again for the time today.
Yeah, I appreciate everyone joining. You know, again, it's such an honor to, you know, work with you all and be part of this at a really, you know, challenging time. And, you know, this will end, and, you know, biggest priority is to be there when it does. So, you know, put this behind us.
Cool. All right. Well,
thanks everyone.
See everyone.